Hi everybody, this is Ellman, the blue collar investor, with today's option selling question of the day. Today's question comes from Quan. Hi Alan, on December 2nd, 2019, I bought 100 shares of Axsome Therapeutics, ticker AXSM, for $33.39, and I sold the January 17th, 2020 32.50 strike at $12.90. And today the stock gaps up to $45.40. The price of the 32.50 call is now $20.90. Do I keep the option until expiration or should I unwind it? If this is your stock, what would you do? Thanks, and it's signed Quan. Well, we have quite a gap up in price with this particular stock. So let's review Quan's trade, see if we can make some sense of it. We'll break it down and then see if any action is needed and whether or not this was an appropriate trade to make for covered call writing. Okay, so here's Quan's trade. On 12/2, Quan purchased 100 shares of AXSM at $33.39 and sold the in-the-money 32.50 strike for $12.90. Only a few days later, on 12/6, AXSM was trading at $45.40, gapped up over $10 a share. And the ask price for the 32.50 call is now $20.90, seemingly an extremely high price to close. So what happened here? What caused the price of this stock to go up so much in such a short period of time? Well, before we investigate, let's see if the original trade that was executed by Quan gives us any hint or any information. So let's take the information given to us in Quan's question and feed it into the Ellman calculator. I'm going to use the multiple tab here, and we're going to enter the information into the blue cells on the left side of the spreadsheet. And here you could see the price is $33.39. The in-the-money 32.50 strike was sold for $12.90. Once we enter that information, the white cells on the right side of the spreadsheet will become populated. And here we could see a return on our option or ROO that's time value only, a humongous 37% for the 6 weeks until contract expiration. So what does that mean? That means that the market is anticipating a huge price movement of the stock. It doesn't tell us in which direction, but it does tell us that there is a lot of implied volatility in this stock by contract expiration. Otherwise, the premiums would not be so generous. Now, upside potential is zero because we're selling an in-the-money strike. In other words, we're agreeing to sell it at a lower price than current market value. That is our contract obligation, and that's why there is an intrinsic value component, in this case 89 cents, which represents a 2.7% downside protection of that initial time value profit. So if we could state it differently, we guaranteed a 37% 6-week return as long as share value does not decline by more than 2.7% by contract expiration. So that's how the trade was set up. And right off the bat, I could tell you that for most retail investors, this would not be an appropriate trade to make because the implied volatility of the underlying security is so high. Yes, we get a very, very nice premium on our option sale, but we are exposed to the downside because of the high implied volatility. So let's have a look and kind of visualize what happened with this stock. There's a 1-month chart. You could see on the left side that it was an uptrending stock, so it was a bullish price chart. And then all of a sudden in the last couple days, it gapped up. And so what caused it to gap up? Well, When we want to know what happened, we check the news. Now, this wasn't an earnings report, which is the most common reason for a gap up or a gap down. So it was not an earnings report. So I checked with finviz.com, and the screenshot will show you the information that I found. And you could see here that Axsome Therapeutics was having a phase 2 trial with the FDA on one of its narcolepsy drugs, and that phase 2 trial proved to be favorable or positive for that company's new drug. So when that news came out, there was a huge pop-up in price by $10 or $11 a share. So that's what caused it. Now, that was expected, and the announcement was expected, and that's why the implied volatility and the premium was so high. But once again, it was a coin toss. It did go up because of a favorable trial, but it could just as easily have gone down, and that is the risk that most covered call writers would not want to take, because covered call writing is a conservative strategy for low-risk retail investors. So the question now becomes, with that strike, the 3250 strike, so deep in the money, because current market value is over $45 a share, should we unwind this position? That was the question that Quan posed to me. So what we do is we turn to the Unwind Now tab of the elite version of the Ellman calculator, and we feed in the information. Let's see if we could figure out whether or not this is a move we should make. Remember, the 2090 is not the amount that it costs us to close. It is physically the amount, but it is not the time value, the actual practical amount that it costs us to close, because the intrinsic value component of that 2090 will wash out because of the share appreciation. Before we close the original short call obligation, our shares can only be worth $32.50. But by removing it, our shares are now worth current market value of $45.40. So we remove the intrinsic value component. That will give us the time value cost to close, which is what this tab will do. So we feed the information on the left side of the screenshot, and the spreadsheet information entered is the price of the stock, $33.39, $32.50 strike, $12.90 is the original option premium. Current market value of the stock, $45.40, and $20.90 is the cost to close, intrinsic value plus time value by buying back the option. Okay, once that's entered, we then look to the right side of the spreadsheet, and once again the white cells will become populated. And if we look to the bottom right side, we see that the cost to close, time value only, deducting the intrinsic value component, is $8 a share, or $800 for the contract. That's how much cash it's going to cost us to close that position, short call plus sell the stock. That represents a 24.62% time value cost to close. Now, the question we ask ourselves is, can we generate a significantly higher amount of profit by closing this position and entering a new covered call trade with a different underlying stock? And the answer is most likely no, unless we use a security that's even more volatile than the original one. So that would be exacerbating a mistake, committing the same error 2 times. Even though the trade is working out for Quan, still doesn't make it right. So in this particular case, the answer is no. We just let it go and keep monitoring the trade. Maybe things will change and an exit strategy execution will make more sense than it does at this point in time. So every trade that we make, successful or unsuccessful, appropriate or inappropriate, has an educational component to it from which we could learn something. And certainly there's a lot of value in exploring and dissecting this trade that Quan made. So let's just review some of those points. Using highly volatile stocks for conservative option selling strategies is very risky and inappropriate for most retail investors. I never would have used this stock in my covered call writing portfolios. Now, if I had another portfolio where I was willing to incur a lot of risk, gambling kind of portfolio, yes, this would have been a possible choice. But for conservative option selling, no. The reason is that high implied volatility securities enhance the risk to the downside, and we're all about avoiding risk. Yes, we're willing to accept a certain amount of low risk because we're looking to beat the market. And in order to beat the market, we have to accept some amount of risk. But covered call writing is a strategy where we want to keep the risk to a minimum. Now, when there is share appreciation, whether to close the position or not will depend not on the actual premium cost to close, but on the time value cost to close. And that figure is calculated for us by the Unwind Now tab of the elite version of the Ellman calculator. Once we get that statistic, then we decide, is it possible to generate a much higher cost to close with a time value premium in another position? In this case, the answer was it's extremely, extremely unlikely. Now, all of these risks can be avoided by using lower implied volatility securities. Well, when I check my 1 month returns, I look for an initial time value return range of 2 to 4%. And I'll go as high as 6% in a bull market environment, but never higher. And that's how I stay out of trouble with some of these underlying securities. So to actually see our entire library of now 169 Ask Alan videos, that is available only to our premium members. So if you log on to the premium member site, you could scroll down on the left side and you'll look for the title that says Ask Alan videos, and you can access all 169 of them, and we keep adding a new one every month. And then on the right side in the resources download section, we have a file that lists the title of all the now available Ask Alan videos. Okay, so what a great question from Quan. So valuable in so many ways. So Quan, I want to thank you for sharing your trade with the BCI community. It was a great question that we learned a lot from. I also want to thank everybody out there for taking the time to watch this video. I hope you enjoyed it, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.